amazing companies are built by immigrant founders.
All right, so
We just did a costume change here.
exactly, we got one more.
We added another.
So this is the first podcast that we're doing at Lumos House. We're trying a bunch of things, and because there's so many interesting people, and there's actually really good conversations, we thought about doing a podcast that we can share with everybody on open conversation, right? Founders and VCs. As a founder, and I'm sure you guys know, there's a bunch of stuff that you think you know about how VCs and fundraising works, what you should do, what you shouldn't do, and how much bullshit to put in your presentation to when you're trying to raise. But how much about it is it true? And Jesse, we have you from Flybridge, and Ihar, we have you from Geek Ventures. I'm guessing different stages that where you guys invest, but let me pass it on to you guys and say a little bit about yourself.
Thank you, Bogdan. Really glad to be here. I'm Ihar. I run Geek Ventures. At Geek, we invest in pre-seed and seed startups in the US with immigrant founders. Typically, it means for us that we can invest sometimes at the early idea MVP stage and sometimes at 1 to 1.5 million ARR at most.
Awesome. Jesse?
Yeah, so Jesse Middleton, as we know each other, I run a firm called Flybridge Capital. We also invest pre-seed and seed. We tend to invest in very technology-forward, AI-heavy companies. We've been doing this. Our first fund was in 2008. We have about $1 billion under management today, but we're writing sort of the first $500,000 to $3 million check, depending on the stage where you're at. In the past, we've really focused on, as I mentioned, like tech-heavy founders. We made a lot of our success in developer platforms. So we were the earliest investors in companies like Firebase and Crashlytics and MongoDB here in New York. My partnership is still on the board today, 15 years later. And so we continue to invest in very tech-heavy companies, technologist-led. Not a lot of hardware. We haven't invested any billboard companies yet, as you guys do in Blind Spot, but yeah, it's been a really fun time. I've been doing this full time with my partners for 8 years. Started as a very active angel here in New York prior to that, where I'd been on the founding team of WeWork, and so I spent 6 years building that and creating labs and ultimately leading to this. So early stage as well, and I think it's for me, it's the best place to be. I have zero interest in being a late stage or growth investor, if I'm being honest. I like to work with founders like from the idea. I just offered terms today to a guy just left Snowflake that I've been working with for 3 years on different ideas, and he's got a memo and a Google Doc and a name of a co-founder. That's where he's at. I'm not even sure he has a name for the company yet, so I'll have to ask our CFO if we know what the name is.
That's awesome. Cool. I've also been at WeWork at some point, and I've started as an angel investor here in New York. So a lot of things in common.
What years were you there?
In WeWork, 2019, 2020.
Okay, cool.
So the most chaotic, really difficult years at WeWork.
Yeah, no, I was there on the rise though. So 2010 to 2016. When I got involved originally, there were 4 of us. When I left, there were about 4,000 employees. I actually met Adam and Miguel through a Craigslist ad. So we had 1 floor in Soho, and I was leaving my company. I ran tech for a public company here in New York, and I was looking for office space for a buddy of mine and I. We had about 12 friends that all started companies right around the same time. And so we sat down took a tour of WeWork and sat down with Adam, and somehow he convinced us that in addition to raising angel money, he actually invested in my startup, that we would come and hang out, and he gave us the second floor of WeWork, which we called Labs, and then we eventually turned it into WeWork Labs, where we rolled it into the business. But it was a wild ride. So I left in 2016 though, full-time, and officially fully out in 2017.
I remember back when I was still an angel and I worked at Facebook, I was invited multiple times to WeWork to be a speaker to some of these WeWork Labs
exactly.
events.
Exactly. We loved having, this is, we were talking about it before you got here, what do I love about this Lumos House? Like, it's the community of people and the conversations that are happening. And one of the views that we had early on in New York, this is in 2010, 2011, is that there was no space in New York at the time to go and just talk about what you were building. There were demo days at like a place like Techstars or an ERA, which are wonderful, but those are about pitching investors, right? This was like, you want to talk about the cool thing you're building to get feedback from other people who are building cool things. Like, where do you do that? And so, yeah, we used to bring people who come from Facebook and Google and Twitter. And the whole point was like, don't pitch your company. Like, just talk about what you're building. And that president of Facebook could say things like, hey, that's really cool, but we're going to crush you. Or, that's really cool, we should talk about how we might work together. Or they just say, that's a neat idea. Like, I'll just, keep in touch.
So, Ihar, you mentioned an interesting point. You invest in immigrant founders. What drove you to this niche, basically?
So I came here to US, it's 11 years ago, and went through this, adaptation period, building my network from scratch, figuring out all the issues that immigrants have, starting from paperwork, then building my new life here, and meeting all the people, and that's on one hand. On the other hand, I kept investing as an angel investor, and I kept seeing that amazing companies are built by immigrant founders that I've seen personally from very early stage. And there is a very well-known statistic that more than half of US unicorns have an immigrant co-founder, right? And so basically immigrants on average, statistically, were more likely to go all the way to the unicorn status and above. And when I was starting the firm, Geek Ventures, back in 2021, the one thing that I got as an advice from a lot of more experienced VC firm builders is you need to figure out a way, how do you differentiate from hundreds of other emerging managers, right? So, and do you want to focus on something, right? So some sector. And I personally was never that much of a narrow sector person. I admire some of the VCs that can go like only healthcare, right? Or only prop tech or something like that, right? So I was like, I know so many amazing people and keep meeting amazing people that I don't want to be focused on just one small niche, because the great founders, especially at the early stage, come in all sorts of sectors. And especially given that my background is on different products as an engineer, as building AI, and like, okay, there is so much technology could be done anywhere. It's like, but what would be my angle? What would be my advantage? And that's where I stumbled upon this idea of like, let's do work with immigrant founders. And there is a lot of proof that immigrant founders have high success chance. They have shown the resilience by actually going through difficulty, like making decision to go somewhere to another country. They have access often to much cheaper labor in other countries. So, some of our companies can hire engineers for $20,000 a year, as opposed to what we can see here in New York. And I also see that's where value add, because after all, one of the important things for VCs is to win deals and to be really helpful to the founders. And I found that with my network and with my experience of building this network, I can be especially helpful to founders who are looking to build their network, right? Who came here somewhat recently, who don't really know what side to approach this US VC ecosystem. They don't know how the US VCs even talk sometimes, right? I mean, in like cultural differences and so on. And what I found is that by aiming our value add in that direction, a lot of founders really like working with us. We have this example of an amazing founder, just like top founder that had his pre-seed filled with French investors. And I'm like, okay, so I can help you connect after us to like a lot of really good US investors. They're like, okay, come on. So, for him, that was a big value add.
But do you think it's harder for an immigrant founder to do business in the US, or why do you think there's a higher drive?
Of course it's harder. Of course, it's like almost there are so many groups that are like, that are underprivileged in some ways, right? But most importantly, when you don't have somebody on your speed dial, like your dad didn't play golf with a VC, right? So, or you don't have a direct access to a potential customer from your school class, right, or things like that, then it's much harder. Or you don't even know sometimes what are the accepted norms. Of course, for immigrants, harder, especially recent immigrants, by the way. And of course, there are some immigrants that have been here for 30 years. It's a different story. For them, it's much easier. But for those that were here like a couple years, it's much, much harder. But at the same time, for them, it's harder. But what we see that people who achieve something, despite that it's harder, right, on the early stage and can show early traction, these are the people that I believe can go all the way.
Interesting. I have a question actually for both of you. What do you guys like in a founder that you decide to invest in? Like,
What do we like?
yeah, like what are
I like when
what
they're going to
are-
make
what-
me money. I don't know.
Of
no,
course.
I mean, look, we've been doing this a long time, and as a group, we think a lot about sort of what are the qualities in our most successful founders, and there's all the things you would typically think about. It's grit, it's perseverance, it's intelligence, it's knowledge in the category that they're in. One of the harder ones to measure, but one of the ones that we find is very telling is we call it the Pied Piper effect. And this is not for those who watch the Silicon Valley show, not the app, but the Pied Piper, the children's fairy tale. I know you have a little one. The one who has the little flute and walks around and people follow them. There are three constituents when you're building a company that you need to attract early on. Customers, potential hires, and investors if you're going to build in venture. And at the end of the day, you have to get them to follow you irrationally so. Like they need to follow you long before you've proven value, right? Closing that first enterprise client with no other proof points other than you made an app isn't going to prove to them that you solved their problems. They have to follow you before they should. The employees that you're hiring, you're promising them millions or billions of dollars in equity, if you will. Adam used to pitch the WeWork story to people, and it was a lot of equity that he promised. You get them to follow you, and when you're hiring employees, this is a thing. And then the last one I'd say is for investors. And you said at the top here, like what's all the bullshit that goes in the deck? Look, one of the jobs that you have as a founder is to entice me enough to take the next meeting, to dig in, to spend time with you, and that same Pied Piper effect comes in. Like you get that first meeting, you have to get me to follow you in a way that is like, if I could tell the story of how successful you are already as a seed investor, you're too late for me. So like that's like I'm not going to make money on that. I can't invest in that. It's not my model. And so I think that sort of effect for us is one that we look for. We do a lot of reference checking. Often it's people who have lived a certain life. They've been through a journey already. They have a chip on their shoulders. Lots of ways to sort of try to vet it. But yeah, that's one of the big areas we think about.
Absolutely subscribe to everything here. We call it like that every great CEO should be a great salesman. By the way, we are very peculiar, maybe more than some other firms in looking at the roles in the company. So we don't like to invest in companies where the founders don't know who CEO is or where...
you don't like three co-CEOs? That's not a good idea?
I've seen it all the time. So, very regularly we see a company where CEO and CTO come to the meeting, and for some reason CTO does all the pitching while CEO stays in the background. Something is off. That's not the right approach, right? So, or when CEO is a minority shareholder, has 5 to 10%, and does the pitching, but not the vision holder, not the core person, things like that. Anyway, what we like is for CEO to be a driver of the company, to be both a visionary and a salesman, right? So I won't repeat what you just said, but three constituencies is exactly what we are looking for, being able to sell the vision. But also what we love is when CEO especially is the person that knows this market in and out and that knows the customers in and out, right? So it's not always necessary, but in vast majority of cases, when you are building a company that's about to sell to some ICP, you should know this ICP for many years, right? So if you are selling to hospitals, you should have connections in hospitals, you should have worked in hospitals, things like that, right? So if you sell to enterprises, you should know how the enterprises work and who are the right people for many years. We call it founder market fit. Early stage is extremely important. And also what we look for is some examples of velocity, of being able to move fast, right? This is why, especially at early stage, we like when we have opportunity to look at the company for at least 4 weeks, sometimes 8 weeks, and between our first meeting and the meeting we basically tell you yes or no, we need to see progress already.
High clock rate.
High clock rate.
Yeah.
It's not like we talk with the founders that we end up investing in typically every week or every 2 weeks, right? And we need to see some news updates from you. Something happened, maybe not necessarily a contract every week, right? But there is some progress. So.
And the next question is, what do you actually hate in founders that pitch you? Let's say, I'm guessing you guys get hundreds of pitches every week. You select, 1% of them to talk. What do you hate? What are top 3 things that you do not like
So I first of all, as I said, when I don't see a clear leader CEO, that's a problem for me, right? And second, I would say when I see, I don't like, and I think it's a very easy no, when the founder tries to convince me that they will make me money and say like, oh, we will sell this thing in 3 years, 5 years, deal with the biggest company in your portfolio. Don't do that. Just focus on your business. And also in the same realm, when the founder is showing that they're looking for a quick exit, right? And that could be, by the way, a very good decision for them. But if they show me these exit scenarios that maybe we'll sell for 50 million to company X, it's like, no, right? So that's for us.
Well, number one is founders who won't make me money. That would be one. No, listen, I would say too many slides. Like if you want to get real particular, like 14 or 15 is the max that an early stage company should have in the deck they're pitching with. People show up and they try to get everything out that they've ever learned about the industry they're in, the business they're building in meeting one, in even pre-meeting one, in the email, the introduction, they share the deck. One of the best qualities that we see in founders, which I know you're asking me what I hate, one of the best qualities is they're able to articulate a complicated thing, their business, in a very succinct way, in a way that I could then retell it. And so one of the proofs of that early on is a very succinct deck, memo, whatever it is they're using to pitch. I don't care if they have a deck or a Notion, doesn't really matter. So I'd say one is like too many slides, too long of a story early on, I would hate. I think the second thing I would say is, a little bit in line with sort of the quick exit or really focused on the exit. We have to believe that there's a lot of value here. And we talk about venture math, and I invest in 40 or 50 companies, and I invest early. I need each one to be 50 to 100x post-dilution, and that's how I get the return and the 3x the fund, whatever. So, but the truth is, I'm looking to invest in people who are going long to build something big. There are lots of opportunities to invest in short-term gains in this world. There's debt. There's things like that right now, super high interest rates. I can find a way to make a small IRR over a short period. What we're looking for is something that's sort of world-changing. And again, if I go back to like at the fundamentals, we're here to make money for our LPs by backing smart founders. And so if you show up at our door and you talk about either the quick win, I agree, or you spend all this time talking about the exit, I feel like you're not really focused on building something of value. And our best returning companies create massive value, not just for shareholders, but for their constituents or other ones, for their customers that create value, for the world around them, depending on the kind of company. And so on the what do I don't like, somebody's going to harp on that. I totally agree with.
Another thing that I would add that I would hate on the call is, or that really don't like working with founders that try to turn the call into a monologue, that they don't let me, give my questions, right? So, and sometimes, so typically it's like at most 5 minutes. At most 5 minutes, you should be talking without me saying anything. and that's even too long. Maybe try 3, right? So it's like, because the moment the founder is like talking nonstop 5, 6, 7 minutes, for a few minutes, I'll try to put some words in and then I'll just give up, and then it's like, and then at some point the investor, not following what you're saying. So just don't forget that your job is not to tell your story as you tell it. Your job is to answer the questions of investor that they care about. And they often care about questions that you can't even think of, because for example, I always like to have, after the first meeting, my feel about the founder's story and the origins and what they did before. And if the founder starts from first minute pitching me this particular product, and then the 30 minutes we pitch the product, I didn't learn anything about their previous stuff, so they missed an opportunity to impress me on what I need. Right? So, yeah.
That's very interesting, actually.
By the way, can I add another thing? So today somebody mentioned on Twitter, really good point, that that vast majority of advice that people give to founders is not applicable to the best of the best founders. And the things that we are talking here, these are probably for 99% of the founders.
Yeah.
But sometimes there are exceptions. I totally see that, there is 1% of the founders, there's absolute stars Larry Pages and Mark Zuckerberg, where it doesn't matter who is the CEO, it doesn't matter if they monologue, nothing matters. They can do whatever they want and they will still have VCs running after them. But the vast 99% of founders should really care about what investors
I put this in the dirty little secret of venture, and I tell this to our
Yeah.
LPs, and I have a lot of VCs that wouldn't agree with me, at least publicly, but for our best performing founders and companies, they're going to be successful no matter who's in their court.
Yeah.
I can only influence so much change. It's not
Yeah.
my job to run your business. I'd be a terrible CEO for almost any business that I backed. I monologue, so this is a problem. But I would say that at the end of the day, for the best CEOs, for us to win, it's 95% picking and then getting the fuck out of the way. I don't know if
Yeah.
I can curse on this podcast, but I'm going to. And so it's when I think about that, I totally agree with you where for the best of the best entrepreneurs, a lot of that advice is a little irrelevant because they're going to win no matter what. Not for nothing. We talked about WeWork at the top. When WeWork eventually went public, it was a $9 billion company. Now it wasn't a 49 or 59 or $109 billion company, but $9 billion of value created from nothing. And so it didn't matter who was in Adam's court, it didn't matter who was behind him. And so I think that is when I think about your question around sort of what do I hate, hate's probably a little bit too strong of a word. We want people with an opinion. We want them to have a hypothesis. I don't want somebody to show up and be like, I'm looking for co-founder. I need somebody who's helping me, who's answering all my questions. I want them to understand their business. I want them to understand the category they're building in. And I want them to prove that they're going to win no matter what. That they're in that 1%, if you will. And, look, it's hard to identify that in the beginning. Otherwise, we'd all have perfect track records, right? But that's why we build a portfolio. And so we hope that 2 or 3 hit that.
Did you guys miss out on an opportunity to invest on something that you regretted later?
Yes. I have a few other partners, and so we are not a consensus-driven firm by any means. We talk about it as highly considered, but the highly considered part is we listen to the feedback from each other when we see a deal. And sometimes there's something I see, I bring it in, and I absolutely love it. And I want to pound the table. I want to invest in this founder. And then my partners come to me and they say, okay, but I have this question. Here's why I don't like it. And they push me on it. We talk a lot about it. And eventually we get to an answer, right? And I make a decision. Sometimes they push really hard. It's like death by questions. It's like it push really hard. And there is a company, I won't name them because they're still going, but they're in the consumer healthcare space. We're not consumer investors for the most part. We're not healthcare investors for the most part. Lots of reasons to not invest, but I love the founders. I thought they were amazing. We're just getting started. Ex-Google guys, starting this healthcare company. And we just could not agree on how excellent the founders were. We were far off from each other. I thought they were excellent, and one of my partners thought they were terrible. And at the end of the day, I listened to them. We went back and forth. We spent all this time. You know what I said? Listen, I might be missing it. You're a good judge of character. You're a good judge of founder. And we didn't do the deal, and today it's $1 billion company, and it hasn't exited, so I'm not going to count it out yet. I'll tell the story one day. We'll see if I really regret it. But you asked a question about a regret, and for me, one of the lessons I took away, this goes back to the 1% comment, the best of the best founders, they're going to be successful no matter what. And so when I have that strong opinion, I see anywhere from 1,200 to 1,500 pitch decks a year. Each of my partners see about the same. I meet with roughly 600 of those founders on phone call or Zoom or in person. Roughly 100 of those people across all of the partners come in and actually pitch us. And we wind up backing, anywhere from 10 to 20 a year. So it's a pretty steep drop off. When you find that founder who's just so special, you can't fall asleep at night without thinking about them. There's just trust your gut would be my takeaway from this lesson. But yes, there are certainly deals I didn't get to do that I regret. But I can't lose sleep at night about it. I have other deals that are $1 billion companies today, and I had to focus on those. They're what are in my court.
Yeah, so the thing is that it takes a lot of time to realize that you missed something, really long time. And Geek Ventures is not that old, we are 3 years old. So in Geek Ventures time, we don't have any $1 billion companies that we missed. But in my angel career that started, 13 years ago, I had one miss, and very, very early. It's literally when I just started, and I was like picking companies, and I came across this opportunity super, super early. I had an opportunity to invest in Coinbase, and I passed. And even though I already owned some Bitcoin, and I understood it was like the market size was very unclear to me. And it took me, I think, about 5 to 7 years to really understand how much of a miss it was. Well, but it happens. Still had enough of other good wins to make a good track record. So the one important thing, by the way, what I want to take out of this misses is that it's important to differentiate the wrong decision at a time from the right decision at a time, regardless of the outcome. Because the one thing that we do over time that we learn, right? So I think on Coinbase I was just wrong because I was super inexperienced. That was my like second or third deal as an investor, right? So and after 300, 200 more deals, I've got enough experience to understand that these are the things that I need to, green flags and red flags that I need to really analyze. But sometimes the deal is just wrong and you shouldn't do it, and it was right that you didn't do it. And then for somehow, it was lucky for the investor that it ended up being very, very successful.
Yeah.
And you wish you've been there, but it's important to follow the process because after all, for VCs, especially VCs that invest, $1 billion like your fund or like 50 companies per fund, it's important to have a really good process, really good deal flow, and just follow it and keep improving it.
Yeah.
Do you guys think AI is becoming a fab? The reason I'm asking this is, as a founder, what I'm seeing is everybody's trying to put AI in their pitch deck. They're doing an automation, they're calling it AI. Do you think is it becoming overused? And is the overuse of AI shadowing actual or founders that actually build AI, like actual AI, not an automation?
So first part of the question, no. Second part of the question, yes. So here's the thing, that over my 12 years of experience as an investor, I've seen all the time founders try to say things that investor wants to hear. Always, right? So because they, after all, looking for money. So I absolutely understand, and it's reasonable that all founders right now try to find a way to squeeze AI in their decks and in their vision, because otherwise it would be stupid, right? So and on the other hand, as an investor, I think it's very unlikely to find a great deal right now that doesn't have any AI in it, because like all the great companies right now have some AI angle, because AI is now such a force multiplier, right? It's such a significant change in everything, in margins and capabilities and in speed, that it would be foolish not to use AI, regardless of what you do. Even if you sell lemonade on the stand, right? You should use AI in some way, right? So, but. And then, even to my portfolio companies that we invested when they had no AI in their deck, like 2 years ago, right? When they started raising again 6, 9, 12 months ago, I'm like, hey man, you should figure out a way to have AI strategy to raise now. But try to think of it from the first principles, not just put AI slide there and like .ai domain, but figure out how to you actually use AI. Like I think the great companies. Great example is a company of ours, Spike Technologies. They just announced 3.5 million seed round today. When we invested, it was API company. It was a company that helped process data. They didn't have AI in their deck. It was 2022. A year later, they were thinking about the next round, and I told them, hey guys, you cannot just be an API company. You have data. You need to figure out what to do with this. And now, I only gave them feedback, right? So I don't claim credit for anything. They figured out the whole vision and the product to actually be a company that knows how to use the data, to actually have generative AI on healthcare data and not be an API company anymore, but to be a company that actually is able to use really good models on the good data. And they made this kind of leap, right? So that they couldn't do 2 years ago because the models were not there.
Yeah, I mean, I really want to disagree with all the things that you're saying because it would make for a more interesting conversation, but I don't disagree. No, look, I think you hit the nail on the head. I think AI is affecting every part of a business today, whether it be productivity, on up the stack, right? So I think that you would be crazy to not think about it as a part of if you go back to first principles, how are you running and operating your business? I'd say I'll go back to what do I hate in a pitch deck, right? If you've got a term in the pitch deck and I can't figure out a way how to describe how it's making you different, I hate that. So if you've got AI in the deck and I can't figure out how that's going to differentiate your business, that's a problem. So I do see that. We only really invest in companies that leverage AI at their core. This is like our thesis and a thematic. We do vertical SaaS, we do horizontal SaaS, we do developer platforms, we do native AI, we do but all of that. So I mean, if I get a deck that doesn't talk about AI, then I'm not going to meet with them. But it's not because
everybody has to put AI
but
in
it's
the deck.
not because I want you to put it in your deck because you put it in your deck. Like if you put it in there and then I look at it, I'm like, well, you're building a clothing company, like, and you use it for what? Like use ChatGPT on your computer in order to write your emails. Like that's not it, right? So I think I don't think that as a trend, as a sector, it's not becoming a fad, but I put it in my deck so I get a meeting. I don't know. I have a pretty low tolerance for that, like a pretty high BS detector. So like I said, the couple, the 1,000 to 1,500 decks like I'm looking at, it's pretty quick for me to be like, you said AI, but it's not, and I'll just not. I mean, I'll respond and say it's a pass, but like I'm not gonna usually fall for it. I fall for it. I do meet founders who have it. The one thing I'll tell you is, we believe that most of the value is going to be created by companies that leverage AI at their core over the next decade, just like companies that leverage the cloud 10 years ago at their core far outperform those who put their things in server racks and bought their own $1 million machines, right? That's I don't know if that's a controversial statement or not, but I'm pretty sure it's true. I think for us, that allows us to focus. It allows us to operate better as a team, to have a thematic, prepared mind and view. And so our prepared mind and view of the world is that those companies will outperform. That allows me to filter at the top, to spend more time at the middle, to make better decisions at the bottom of the funnel. And so I agree with everything you said. I would suggest that you may say it'd be stupid to not include it in your deck. I agree because it's probably in the founder's best interest. I think that if it's a layer on top of like, it's like what you use, like your superhuman email client uses AI to let you write replies, I'm probably not going to take the meeting, even though you are using it. I agree with that.
Yeah, so to add to that, I think there was always, even 5, 10, 20 years ago, there was some bullshit in the decks, right? Because all founders are looking for a way to kind of pass the filters and get to the meetings. Now, this bullshit is all around AI. So, and the best investors are the ones that are able to filter, exactly what you said. And 5 years ago, you didn't need to look at so many decks that have AI in it. Now you do. But the difference is that you still need to make the consideration and figure out roughly the same percentage of decks as before get from a deck to a call, right? So and I think that where some AI experience from before helps also, right? So for example, for me it was, I was working on AI as a software engineer back in 2009, 2010, right? So and it helps me to exactly see where the AI is just a fad, where the business person just put it without understanding, or where there is actually a technology that we need to. But I think the one interesting angle is that you now get more competition, because if you were focused on only AI companies 5, 10 years ago, there were fewer VCs and fewer percentage of the companies were fewer. But now, because the AI is so, it makes sense. There is just, first of all, a much larger percentage of the companies actually use AI in a big, significant way. But second, there are so many more VCs that are very actively looking at AI. And as I said, for example, for the last year, I think, or more, we didn't invest in a single company that didn't have AI at their core. Even though in the thesis of our firm, we don't talk about AI. But it just makes sense to invest in AI.
I will say, by the way, on the BS detection thing, in our LP deck, for both our annual meeting, when we think about fundraising, like we have a model around the AI stack, from the compute layer to the large models, and then we've got the layer of applications from developer platforms, data on up. If I can talk about the AI stack better than you can, we're not passing the bar. Like, you're just not. You need to have a depth of knowledge, and so we have a bias towards more technical founders. Even if it's the CEO, they should have spent time in the space if they're going to use it, if that's going to be their pitch. And all the more power to you if you're not, right? There's plenty of investors who want to invest in amazing consumer apps. There's plenty of investors who want to invest in vertical SaaS that doesn't have AI at its core, although it's becoming less and less common that you find somebody pitch that. But I think, it's something where it's certainly a lot more noise. There's a lot more decks with it, but we've got to just filter it.
So we're almost getting ready to
start. We got a whole
so
crowd forming here. So.
Just one last question. Do you guys see more bullshit recently in
and you're
the
really
decks?
on this topic.
Or listen, it's a founder versus VC, and a lot of it's beautifying everything, right? Do you think it's more bullshit, or the amount of bullshit in the industry is increasing, or it's been kind of stable?
First off, I just want to point out something. I think at the early stage where we invest, I hope founders don't think of it as much a founder versus VC. Like, we're coming in roughly at the same price that you are, not much more if you're going to build a massive company. Like, we are very aligned for you to exit even the 100, 200, 300 million dollar exit, which is not necessarily maybe what we're thinking about for 100 or 500x return. So I'd like to think that we're somewhat on the same side. Obviously,
Yeah,
you're pitching,
I
you're
don't
selling.
mean it on on opposite sides.
But I think it leads to this question about, is there more bullshit? I think one of the challenges is, yes, often there is. There's a lot of fluff that comes into the deck. This is why you wind up with 50 slide decks, right? They're like, I need 7 slides to explain this thing that I could have done in 1. But I think part of the reason it exists is because founders feel like they have to spar with the investor. They feel like they need to prove something that's going to like win the investor over. And it's rare that it's one thing that you say. It's rare that it's like one slide or one word or one sentence. It's about, to me at least, it's the founder, to your point, the journey they've taken, how they've gotten here, why they're uniquely positioned to solve this problem, why this solution is so unique. And I think when I think about sort of, is there more BS? Yes. I think it's kind of a shame because while we don't invest on metrics, we're too early for that. We do invest on being succinct. We invest on understanding what you're doing. One of the best founders of my company back 7 years ago in our portfolio is a Web3 company, basically building the Akamai of Web3. It's called Bloxroot. And Yuri, the founder of that, I remember sitting at breakfast with him in a time where everybody was Web3. Every single thing you saw. And he sat at breakfast, and about 10 minutes in, I turned to him. I was like, listen, I've heard 1,000 pitches this year about this. You're the first person to explain it to me, what you're doing, in a way that I just get it and I could retell your story. It's Akamai for Web3. I was like, I got it. Like, why didn't you just say that? And so I think like founders would benefit themselves a lot to pull a lot of that fluff out if they can. And I would encourage them to, because I don't think they're really fooling anyone, to be honest. And I would say the same, by the way. We also pitch LPs. We have a deck. We try not to include a ton of fluff in there either. They go into our data room and it's a lot of data. It's actual data. We try not to leave a bunch of BS in there.
So, so it depends. Is there more bullshit? Depends on the time frame, right? So, when I compare it to like 10 years ago, then I think yes. And the biggest difference is that there is just orders of magnitude, probably hundreds or thousands more early stage founders looking for money. And I think that just the industry changed so significantly over the last 10, 15 years in terms that that raising a $500,000 round became significantly easier right now. There are just so many small VCs that they just like, it's possible. And a lot of founders that 10 years ago would get nothing, crickets, getting $500,000 now, $1 million now, and they encourage other founders. So I think there are a lot of founders right now on the market that will raise $500,000, $1 million, and then will get nowhere. And it's just like the
don't
level.
trust their advice. Like the Twitter thread about I use this memo to raise 500K, look at me in 24 hours. It's not going to work again.
Yeah.
It's like each time it's harder to say.
That's one. But on the other hand, on the other time frame, I think over the last year, situation improved significantly, because what I see is that really strong founders, not even 1%, but like top 10%, didn't want to raise in early 2023 because the market was so bad that everybody knew that, oh man, the valuations are low. Nobody, like really top investors don't want to deploy capital. They sit low. They either were in their companies, CEOs of their companies were like, we need to just wait until the market gets better. Or if there were employees somewhere, they didn't want to start a company in that market. In 2024, I see everybody getting out of the bushes, right? That employees of the companies start their own startups because they see that now you can get money, right?
Yeah.
That much better valuations than everything. And CEOs of the companies that didn't want to raise last year are raising now. So I just see much better pitches and much better founders this year than last year.
Totally agree. I have no other words.
So we don't even argue at all.
We'll try again next
It's a
week.
shame we're gonna try it again. Well, gentlemen, thank you so much. Let's let the people start to enjoy the party. Jesse, Ihar,
Let's
thank
make
you.
some great
Bogdan,
connections.
thank you for
And
having us
hope
here.
we shared some interesting information.
Thank you.